Hey guys, John Polamy here, Actionable Intelligence. Today is Thursday, December 30th, and this is part one of my 2022 forecast. In the past, I've made forecasts in the past at the beginning of the year. This is a trend you're going to see. You're going to see a lot of people making forecasts. It kind of takes you back to memory of what Yogi Berra, the famous Yankees catcher, who was famous for making various quips. He said it's hard to make predictions. It's hard to make predictions, especially about the future. But I think some of the things that I'm going to talk about today are just continuations of what we're already seeing in 2021. That does have a risk of recency bias, but as it applies to energy, I don't really see too many things coming on the horizon, with the exception of possibly a worldwide recession, which I don't think anybody's really forecasting for the first part of the year to derail what I think is going to happen in energy and specifically in oil markets. So let's go ahead and get started. Again, nothing that you hear or see here is to be taken as investment advice. This is for informational purposes only. I am not a registered investment advisor. I am not here to give you financial advice. I'm just a guy on the internet. Please do your own due diligence. These are my own opinions and should be taken as such. So one of the things that I think the themes that we talked about last year that kind of emerged and became apparent, and something that I've been thinking about, other people have been thinking about, has gained traction throughout 2021, and I think is going to continue to be part of the general narrative for most people, is the energy crisis that's emerging that will continue. Obviously, you know, we've seen recently what's happened in Europe with surging gas prices to the equivalent of somewhere around $250 a barrel in energy equivalent. We've seen the record electricity prices. And although this has pulled back recently because it's gotten a bit warmer in Europe over the last week or so, but this is kind of indicative of what, you know, was forecasted by people that were pretty smart, you know, that had well thought out ideas about energy, that you cannot have an energy transition willed by politicians and environmental activists. These things, when they do occur, take decades based on previous energy transitions. And I think policymakers decided that they were going to mandate this, and they didn't give any thought about how it was going to happen or the technologies that they were using. The first blurb here, you know, I said in this slide: poor policy making and recency bias, always thinking cheap gas would be available on the spot market, and from Russia, by the way, are already leading to an emerging energy crisis in Europe. I think this is not just in Europe. I mean, a lot of people are relying on natural gas now, and you know, with the exception of the United States and some other areas like in North Africa, you know, in Russia, the gas reserves are not there. So you're wedded to contracts, pipelines, LNG carriers, the spot market. And gas was so cheap for so long, I think people thought, and policymakers, especially in Europe, thought, well, we can have this energy transition and we can always have natural gas backup. It'll always be available. And that's just a, you know, typical recency bias. You know, today will be like, you know, today will be like yesterday because yesterday was like the day before. I mean, it's, you know, and tomorrow will be like today. It's not how things work. So this crisis, energy crisis in Europe, for example, is being exacerbated by more bad policy prescriptions, in my view. Germany closing its nukes, Belgium talking about doing it, ongoing dispute with Russia, who is the primary supplier of natural gas to Europe, over, you know, Eastern Ukraine. You know, this has more in-depth policy and geopolitical discussions more than I want to have, but that's suffice to say. And, you know, and that's leading to a delay on starting the Nord Stream 2 pipeline. It's ridiculous that you would have soaring natural gas prices, and you wouldn't do everything you could to alleviate that. So this, good luck with that policy. And then again, another bad policy decisions that were made around failure to take advantage of domestic natural gas resources. There are tremendous shale resources in both the UK and in France, and the politicians in both countries have bent the knee to a small group of environmental activists when they could have pursued, developing these in a environmentally friendly way and supplied some of their own gas. So they've chosen not to do that, and now they're reaping the whirlwind. So the answer is do more renewables is the answer as electricity prices skyrocket. Most Western governments are moving to net zero policies, which will continue to dent the supply of fossil fuels. So, this is going to exacerbate as we go through this decade. I believe there's going to be energy shortages. You're already seeing many of the manufacturers in Europe. There's been quite a few, as I've reported in previous weekly updates, about shutdowns of zinc smelters and fertilizer plants and all kinds of different industry. And in Germany, the industrial sector is already complaining to the government about the rise in power prices and how it's affecting their ability to be competitive. So you're seeing this in Europe right now, but I suspect that, across the Western governments, Western OECD countries, you're going to see more of this because they have wedded themselves to this net zero policy and demonized fossil fuels. So we have this constriction of supply. We have, small activist funds getting on the doing proxy fights with companies like Exxon to get them to change from their core business, which is the extraction and production, refining and marketing of oil and gas. And, they have got the ear of very large money managers like BlackRock. And these people are voting along with them and forcing change at a lot of the multinational oil companies. So you're seeing this incremental ratcheting down and making it more difficult to operate, more costly to operate for these oil and gas companies. And that's necessarily going to lead to supply constriction. Not to mention the fact that the multi-year deficit in spending on new production, the finding of new reserves, exploration and production, there's been a big gap in spending. And because, as I've said many times, the necessity to continue to invest in new production in an extractive industry, which declines over time, is a necessity. And it certainly has not happened. We're just seeing news item after news item that is leading to the fact that we are going to be undersupplied with hydrocarbons in the near future. This is going to lead to extremely high prices. It's going to lead to all kinds of knock-on effects, which I'm not going to go into. I will go into agriculture in a subsequent video, but in industry, in political and social upheaval, it's going to lead to a lot of problems that I can't even foresee right now. The fact of the matter remains that if you look at the energy usage of the world, it continues to grow in the emerging markets, and it's mostly fossil fuels. And we cannot just go and change everything in 10 years because environmental activists and, slippery politicians have decided that this is what they want to do in 10 years. It simply won't happen. Yet, if they continue to do these destructive policies, they're going to force up the cost of energy. So I think that energy will continue to be a place to invest and speculate. Eventually, hopefully, we will have rational policymakers come along that will fix this, but usually you have to go through a tremendous amount of pain before you get to the solution, right? You have to try everything else first until you get to the solution. So, declining supply running into increasing demand. And as I've said before, don't forget natural decline. Exxon did a presentation a couple of years ago where they estimated Worldwide declines to be 6% a year. That's overall. So on 100 million barrel per day of worldwide production capacity, which probably, let's just say that is the, plus or minus where we're at right now, depending on where we are with the demand getting back to normal. 6% means you have to find and bring online 6 million barrels per day of new production every year just to stay, with your head above water, to meet demand, to overcome the depletion that naturally takes place in oil and gas fields. Not to mention that the historical narrative of the last 40 years of an incremental 1 to 1.5% increase in demand every year at 100 million barrels, you're having to add 1 million to 1.5 million barrels per day of new production every year. That's compounding on itself based on emerging market and developing market demand. So you're looking at having to find and bring online 7 million barrels per day of new production every year, and we simply have not invested enough money. So we are heading to a brick wall. I don't know if it's next year, but you can see already today as I make this video, Brent is knocking on the door of $80 a barrel, and WTI is like 76 or something like that. These are, you're up tremendously from last year. So the trend seems to be up. I don't know where we go. There's been projections. Goring and Rosenzweig, for example, in the recent commentary, has suggested, based on their analysis, that in the second half of 2022, because they believe that OPEC will not meet its call on new production and more oil, that the world could get into a situation where the world's demand, as it normalizes, which I'll get into in the next slide, as it normalizes and continues to grow, will exceed the pumping capacity of the world. If you get in a situation like that, price will ration. And is that $150 a barrel? Is that $200 a barrel? I can't forecast that. So for investment and speculating purposes, what's the theme for next year? Cash is king. The disease that cannot be mentioned, current new variant, appears to be making the disease endemic. We're seeing the data now come in. You can believe what you want. The data is what it is. You can see many governments, especially in the US, it's kind of amusing to watch them now pretend that they didn't say what they said before, or walk this thing back as they're getting rug pulled by this basically what amounts to, for many people, a head cold. So hopefully that will continue, but if it does, this should lead to normalization of demand. And as I've noted in previous videos that I've made recently, China and India are already above pre-pandemic demand levels. So they are already exceeding the levels of demand that happened pre-pandemic. This is what you expect, right? The emerging markets are going to continue to develop. I've talked about the difference in energy requirements or demand between the developed world and the developing world. It's a tremendous gap. And as these people become wealthier, their demand for energy is going to continue to increase. And as we constrict supply, as we don't invest enough, this is going to create a problem. So one of the things I wanted to note here, and I think is something that a lot of people may be still missing, is that even at current oil prices, many companies are exhibiting double-digit cash flow yields, okay? I can show you company after company that basically went into austerity mode. They didn't do any new drilling. Sandridge is a perfect example. They're just harvesting, blowing down production, spending just enough to maintain their production, to keep the wells running, keep everything going. And they're now generating tremendous amounts of cash flow, right? Especially a lot of the Canadian juniors, even some of your big cap companies like Suncor and CNQ. I mean, these things are turning into cash flow machines. Oxy, some of these companies have a lot of debt like Oxy, but if you just look at the cash flows and listen to what the management say, what they're going to do with that cash flow. It's tremendous. We see companies, there are certain companies that we have seen that some of the Canadian E&P smaller, they have 25% or more free cash flow yields at current oil prices, and we expect oil prices to go higher. So, this is tremendous. So what does that mean? Well, based on what managements have been communicating for the last several quarters, the drill baby drill era is over with. As I said, there's many companies that basically froze. They're not really froze out doing any new production, drilling new wells, just doing maintenance CapEx, just doing incremental, well workovers, things like that to keep the production as high as they could without spending, millions of dollars and going into debt to drill new wells. Based on management's communications, what I've been reading in a lot of their communications and conference calls, debt pay downs are number one, and then share buybacks and dividend increases. That's what we've been told by company after company after company, and they're executing, right? Companies are paying down debt. I have a company in the portfolio that has focused on debt pay downs. It's a Canadian operator, and it could quite conceivably cash flow $1 billion next year. Okay, and the market cap is maybe double that, I think. So there's another company that I think will cash flow close to its current market cap, and people are starting to recognize these stories now. And I think that as long as the oil price stays at $70 or above, these things are ATMs. They're just going to continue to cash flow. And I think that after the first of the year, people are going to start, analysts, the investing community is going to start realizing what's happening with these companies. And I think you're going to see a sentiment change towards them as cash flow, dividends, and share buybacks become a incentive for people to rotate into these names. And I think that's going to happen. I think that even your big cap companies are doubles from here at current oil prices, many of them, just based on some of the cash flow yields. So basically my forecast for basically next year is I expect oil prices to move higher throughout 2022. There's an increasing chance that OPEC is not able to meet its call for production. I think that we've seen that, and I've talked about that several times over the last few months, whereas OPEC has increased its quotas by 400,000 barrels per day each and every month since August. And I think it goes into February or March of next year. We see many countries, Nigeria, Angola, several other countries unable to meet their quotas, right? So they're just leaving money on the table. No, they are unable to increase production. Why? Because natural declines have, made themselves known and have not been compensated for by increased spending. So again, we're seeing that. And I think that is going to possibly be the big story of 2022. The view that, as the data starts to come in, as prices keep slowly but surely moving higher as demand comes back, and things normalize and get back as I believe they will, if we maintain the current trend on the variant, it's going to become apparent that OPEC can't meet the call for new production. And then you could forget about non-OPEC because there simply hasn't been enough investment. And that leads me to the other theme that I'm getting more and more excited about for next year. Oilfield services are quietly rebounding. If you would look over here on the left, this is a chart that I saw, two charts, and I'll explain them. Basically, you have the total spending in billions of dollars on the right, and this is the percentage change, year over year CapEx change. You saw in 2020 during the, pandemic, we had a 27% drop in oil field spending. You see back here in the heyday of 2012, 2013, we saw a, where we were up around $500, $600 billion a year. We're half that now. We've been, basically down at these levels for the last 5-6 years. You see these. We're not in this era over here where we were increasing production, and now we're living off the reserves and production that was, paid for back here. And you just see multi-years, these shale collapses. And then of course last year, but what you see is, in 2021, an estimated 9% increase in upstream CapEx, and then a forecast of 13% CapEx increase for 2022. And this is still, according to JP Morgan's estimates, 40 to 70% below where it could be given the prevailing oil price. So here's your oil price here, and here is CapEx that you would expect to see. This suggests that the upstream continues to be starved of capital. So you should be along here, but you are down here. So we've been talking about this for the last year at least, and this is going to, I think, be one of the major drivers of an increasing oil price in the next couple of years. However, we have several companies in the portfolio that have underperformed. They're down massively. We just got done going through one of the biggest oil field services depressions, probably the biggest oil field service depression in the history of the oil and gas industry. And so we have found the survivors. The companies are, I'm not saying booming, but they are coming back, okay, and quietly coming back. I'm staying away from the offshore rig operators. I just don't have enough confidence that they are. Why try to pick the right one? I'm not saying that they won't do well, but there still needs to be a lot more retirements that need to happen in drill ships and rigs that I think need to happen to get day rates up. We're not seeing that. But what I'm focusing on is the things that these rigs need, or that the oil companies need to do the offshore oil exploration and production. So I'm focusing on geoscience, right? The company in the portfolio that I have is at multi-year lows, and yet if you look at the actual business, it is on the upswing. They're seeing increased orders activity sequentially and year over year, double digit, and cautiously optimistic about the future. Offshore supply boats, that industry has been completely decimated. That's slowly but surely coming back. One of the companies I have in the portfolio is, I consider, the industry leader, and is already seeing shortages of certain classes of boats in certain areas around the world, specifically offshore West Africa. They are reactivating vessels, and they expect to have all of their laid up vessels either scrapped or reactivated by the end of 2022. So we are seeing the recovery. Equipment and service providers, there's a company in the portfolio that is one of the world leaders in various services and equipment for the drilling of offshore. They're saying the same thing. They're cash flow positive and earnings positive. They're at multi-year lows. And so if you see, as I say, that the upswing in spending is happening, which it has to, and I think in a rising oil price environment, you're going to see increased cash flows, and inevitably you're going to see an appetite for having to go out and replace reserves at a minimum. I'm not saying you're going to get back to the boom times. I'm not saying you're going to have years like this, but there's no way to tell. If we get to $100, $120, $150 a barrel, I mean, all these stocks are going to soar on anticipation. But I think that the managements that I am listening to and following, and the portfolio companies, they haven't really moved yet, but the businesses appear to have turned the corner. Now, obviously, like I said, all the portfolio service companies are cash flowing positive. I think a couple of them one of them has actual earnings, but cash flow is what we're worried about. Debts are manageable. Refinancings have taken place. This industry has been decimated. The dross, the weak and sick, the over-indebted have been driven out of business, bankrupted, restructured, merged. So when this thing does, when the industry does turn, which I believe it is now, the increased dollars are going to go to fewer operators. So I think that gives you torque and leverage to a rising oil price. So I think this is why I'm very, no one's talking about oil field services. No one's talking about the companies I'm talking about. But I think that if you have patience, I'm not saying it's going to happen in the first half. I think you see a gradual quarter over quarter improvement. That's what a lot of these managements are seeing, forecasting. They're seeing more interest, more inquiries. And I think as the oil price moves higher, These companies are going to shift from, paying down debt as we go through that stage and start focusing on increasing reserves and production that will be in decline. So this is where I think things are going with energy. Natural gas, it seems like this is a very volatile market. I don't necessarily have an opinion on it. I think you just stick with these operators offshore, and I think that it's such a beaten down business. And I think when it does come back, which is inevitable, and you might have to wait to the second half of 2022 or early 2023 to see it, but I think that starting to accumulate shares now is how we do this. It's funny. I had a lot of subscriptions increase in the last part of the year, and I'll talk more about this when I talk about uranium in a subsequent 2022 forecast video. But a lot of people chase the shiny object. No one wanted to talk about uranium companies 2 or 3 years ago when we were buying Paladin at 12 cents. I remember having a call with Trader Ferg. I mean, this is maybe 2 years ago, and we were, on the call. I was actually buying shares in Australia of Paladin for like 12 cents a share, so no one cared about it. No one was talking about it. It was the same small group of FinTwit people. And now you see, where uranium stocks have went. So yet you have a lot of people now coming into the market. So the 10 times returns are not necessarily from this point in uranium. How you get 10 times, 20 times returns is buying these industries and having a thesis and putting together a process where these companies, talking about offshore services now, are going to turn, and they're at such depressed prices. The time to buy them is now. If you wait until everybody in finance acknowledges, or everybody on Wall Street acknowledges that the companies have turned, these stocks will have already moved 2, 3, 5 times. So that's my recommendation. There's no reason to go all nuts into these things. I just been picking away at some of these companies in the portfolio myself, my personal portfolio, and I feel very confident as I said before, spending's increasing. That's going to continue to increase, and I think if the oil price accelerates closer to 100, goes over $100 a barrel, you're going to see more companies start improving projects, and this thing's going to ramp up. All right, guys, that's it for part 1 of my 2022 forecast. Like I said, no one can know the future. We just try to take the facts as best that we can, the information that we have, and then try to sit and noodle through what we think the most highest probabilities are. That's all we're trying to do here. What's the highest probability based on the information we have now? Obviously, if things change and information can change, then we have to possibly change our thesis. What's at risk? Well, we could have a worldwide recession, could force oil demand down, and then the price would go down. We could have, some kind of flare up with a war in Ukraine with Russia and the EU or something crazy like that. China could go after Taiwan. I mean, all these things are unknowables. They are, very low probability events, but would have high impact to possibly to our thesis. But this is unknowable. We have to go with what's the highest probability. And the highest probability is that things will continue to improve in the oil industry. This business is not going away for decades. And the underinvestment and then the added rocket fuel of governments and society as a whole demonizing fossil fuels is just going to lead to undersupply when demand cannot be replaced by anything legitimate. So that's it for this particular video. Thanks for watching, and we'll talk to you soon.